Hi there, welcome to Kneppy Invest. A few days ago, I did a video called Why I Bought This Stock on a company called IPG Group. Now, I really liked doing that video, and I thought I'd continue this sort of series moving forward using the same sort of format. And the other thing is, I think it would give the viewers of this channel a little bit of clarity about what I actually look for, some of my rules, guidelines, signals, when it comes to acquiring companies. So I thought I'd do a very similar format in regards to why I bought another company called DGL. Now, when it came to IPG Group, the only significant red flag against that company was it had only been listed on the ASX for 2 months. I prefer to wait at least 6 months, but everything else was looking fairly good. The share price was in an uptrend. They released a profit upgrade, that sort of thing. The company is profitable and operating cash flow positive as well. When it comes to DGL Group, or DGL, this company has been listed on the exchange for over 6 months, but it's not quite as clear cut as a buy as IPG Group. And I actually did have to think about this, and there were a couple of rules I did have to just maybe not ignore, but look at with a little bit more flexibility. So let's get into why I bought DGL. But before we talk about why I exactly bought the company, or some shares in the company, I didn't buy the company outright. Just a few facts in regards to what DGL actually does. DGL Group is primarily a chemical manufacturing. Now, in saying that, they do have a few verticals here, 3 verticals: chemical manufacturing, warehousing and distribution, and environmental solutions. In terms of the biggest division, it is chemical manufacturing, which brought in $97 million of revenue in the recent financial year, but warehousing and distribution brought in $40.9 million, and environmental solutions $63.4 million. The biggest growth division in the previous financial year was warehousing and distribution. Revenue grew 48%. The other 2 divisions grew by 3% and 2% respectively. Now, in saying all that, and I do recommend going to the website or having a look at their prospectus to understand exactly what they do in these different divisions. This company has been acquisition hungry over the past, really about, I'd say about 5 to 7 months or so. So let's have a little peek at all the acquisitions this company has made. DGL Group has made 7 acquisitions since July 2021, since they did list on the ASX. And possibly one of the reasons they decided to list on the ASX was they had all these acquisitions in mind, and they had access to more capital, and that's why they decided to list, because 7 acquisitions in a short period of time is quite a bit, and that can lead to some problems in integrating these acquisitions into the company. It seems like these acquisitions are going well right now based off some news the company did release recently, and the implied EBITDA at acquisition was $15.2 million. Just keep that number in mind. Cash investment $38.4 million. They issued 17 or almost 18 million shares to make all these 7 acquisitions. One of the acquisitions was OzBlue. That was in November 2021. A really good timed acquisition, because if you know what AdBlue is, OzBlue is one of those companies that do manufacture AdBlue, along with Incitec Pivot, whatever it's called. That company, I think, received something like $20 or $30 million in government grants to make sure AdBlue, or there's enough AdBlue in Australia to keep the trucking industry going or moving forward. Anyway, so a lot of acquisitions this company has made over the past 7 months. And the most important thing when it comes to acquisitions is how well these acquisitions are integrated into the company. And I'll discuss that later in the video. Now, these are some of the rules, guidelines, or signals I do use when deciding to buy shares in a company or stock. Now, sometimes you'll hear me interchangeably use the word company and stock. They can be interchangeably used. They are talking about the same thing, but I do know some people who don't like the word stock because they believe it underplays the whole reason why you buy shares in a company, because you are becoming a shareholder in a company. But in my opinion, the word company and stock are almost exactly the same thing. Anyway, these are some of my rules, guidelines, probably the better word, because a lot of these rules are quite flexible in their use. For instance, in rule number 1, 6 months after IPO, I will be flexible with that if I do find some other buy signals in the other 4 below it. Share price in uptrend, less flexible in that. I want to see the share price of a company I buy into in a well-defined uptrend, just because that means there's some positive sentiment behind the company, the market likes that company, that sort of thing. I do like to look out for breakouts on positive news, in particular trading updates or profit upgrades. That's what I've done with DGL. They did release a profit upgrade and I bought on the back of that positive news from the company. Also like to see a company having positive operational cash flow and being profitable. Those are a little bit more flexible, but when it comes to the growth of the company, I want to see growth, particularly in their revenue. We don't have to see growth in operating cash flow or profitability, but that is preferable. But growth is definitely less flexible when it comes to that rule or guideline. Also, look at the value of the company. I do prefer some good value there, but again, that's going to be a little bit flexible, and that is probably the most subjective rule or guideline when it comes to my 5 rules right here. DGL is a recent listing on the ASX in terms of less than a year. They listed on the 24th of May 2021 and the share price at listing was $1, and the share price has tripled from when they listed because there is a lot of positive momentum behind this company in terms of the financial performance and also a lot of positive sentiment around this company among investors. And you just be able to see that positive sentiment just when you look at the chart. So this company has been on the ASX for over 6 months. We have seen financial results released by the company, full-year results released last August, and we'll see half-year results released in, well, the next few weeks, hopefully. But we already know what some of these results will show us because they've given us those results, and they've also given us some guidance for financial year 22, which will be released in August of this year. And everything's looking really positive thus far for DGL Group. Now, to figure out whether the share price is an uptrend, all you have to do is look at a chart, and this is sort of the chart you want to see if you do buy into IPO of a company. So again, this company listed at around $1. I think share price opened up about 95 cents and then rose through the day. And that is the share price flow for this company during their history on the ASX. This is exactly what you want to see if you do take a part in the IPO of a company. But the majority of companies that do IPO see the share price actually fall during the first 9 months they are listed. That's complete opposite to DGL Group. Share price has been rising. It's risen from that $1 to a current share price of $3.08. So share price has tripled, particularly from when they listed in May all the way through to September. That's when we did see share price rise by a significant amount, that tripling. And share price has been going sideways. And even though the share price is still an uptrend, which is portrayed by that sloping black line, it's hit that uptrend about 3 or 4 times since they listed. It has reached this resistance level right on $3.20 twice, but once back in September and then again towards the end of December. Now, the share price almost got to that resistance level when they released a positive announcement a few days ago, which was the reason I bought into this company. I would have preferred the share price to get above that resistance and stay above the resistance. But the way I'm looking at this is there's still a lot of positive sentiment behind this company. In fact, the share price rose 3% on the last trend day of the week, which is the 11th of February. Even though the overall market was down 1%, we saw the share price of this company rise 3%. So I think what's happening now is all those shareholders who had bought in over the past 3 or 4 months at slightly higher prices have seen the opportunity to get out at break even with this company. And if we do see the share price rise above $3.20, that would be a very bullish move. And I think the probabilities of DGL share price going above $3.20 is quite high. And that's why I took a position, even though there's really been no buy signal when they did release this positive news the other day. The other probably buy signal would be if the share price fell towards $2.60 to $2.70, reaching that uptrend line. There is a possibility that might do that if we see overall weakness in the market. But I'm betting right now, by taking a position in this company, the share price will go above $3.20 quite soon in the next few weeks and remain above $3.20 for the foreseeable future and hopefully for the next 5 to 10 years. Before we get into the trigger point for me taking a position in DGL Group, which was a breakout on positive news, and it was a profit upgrade, the most powerful sort of announcement a company can release. I'm just going to go back in time to their financial year 21 results, which were released in August, and also the AGM in December 2021 in regards to guidance the company did give. In August 2021, they mentioned they expect to exceed prospectus financial year 22 forecast of pro forma EBITDA of 29 million and profit after tax of 10.4 million. If you don't know what pro forma is, usually that's taking into account if they made any acquisitions and they held those acquisitions for the full financial year. And that's quite relevant for DGL Group because they've made 7 acquisitions. They haven't held these acquisitions for the full year, but they're saying with the pro forma, what if we did hold those acquisitions for the whole year? These are the results we would have had. Now, that's very useful using pro forma EBITDA, profit, operating cash flow to compare that year to the following year. Now, you shouldn't compare those results or those pro forma results to the previous year because you might see significant growth or probably overgrowth to what the results really are. But I do like to look at pro forma results and actual results from the company that they actually do receive, release. Anyway, in December 2021 AGM, they still expected to exceed prospectus EBITDA forecast of $29 million in EBITDA. But because of those acquisitions, they are expected to receive $15 million more of EBITDA. So that would increase that EBITDA to $44 million. So that's the number we have to use moving forward, $44 million. So let's have a look. They also mentioned here, financial year 22 earnings guidance will be provided in conjunction with the mid-year results. That didn't quite happen. I think the company got a little bit excited, and that's why we saw the company release a profit upgrade before they released their mid-year results. And here is that profit upgrade from DGL Group, released on the 9th of February 2022, titled Strong Earnings Growth 6 months to December, Financial Year 22 Results to Exceed Forecast. So remember, they expect, or the prospectus EBITDA was 29 million. They also had $15 million through acquisitions. So the number we're looking for in terms of EBITDA is 44 million. And they did give us an upgrade to that EBITDA forecast, and that's now at 54 million. So a nice increase from 44 million to 54 million in regards to EBITDA. They're also expecting revenue to be 343 million, which is a significant increase what we saw, this company saw in financial year 21. Even the pro forma revenue is or significantly higher than the pro forma revenue as well. 6 months, so that also gave us the 6 months or the half yearly numbers here. Revenue 143 million, EBITDA 23 million, and profit after tax 9 million. Is DGL Group operational cash flow positive and profitable? Well, we've already sort of talked about that, and they definitely are operational cash flow positive and profitable. And this is their 4-year history going back to 2018. We have revenue, EBITDA, and cash flow from operations in this particular graph. And revenue has climbed from 63.8 million to 150.4.5 million. Now, these numbers in the most recent financial year are the statutory numbers, not their pro forma numbers. So this is not assuming that the acquisitions they made were for the whole year. It's just only part year. So you can just see the difference in revenue. Statutory was 155 million and pro forma revenue was over 190 million. But in the most recent full year, EBITDA 16.4 million and cash flow from operations 19 million. And the most important thing here is, are these financial metrics growing through time? And they most definitely are. We've seen revenue grow from 63.8 million to 154.4 million, and we're going to see it grow in the next financial year by a significant amount, even taking into account acquisitions. So there has been a fair bit of organic growth happening, and also fairly good growth in EBITDA and also cash flow from operations. I'm just going to go back one slide because I totally forgot to talk about some of the commentary they made in regards to this profit upgrade. They said that these good times the company has been experiencing is continuing into the second half year of the financial year, and they expected to, I think they said they expected to continue for the rest of the calendar year. It might be misquoting what the company said at that point. Anyway, the other thing they mentioned was those acquisitions they have made have been integrating well within the company. And that's exactly what you want to hear the management say in regards to past acquisitions. Now onto whether DGL Group is undervalued, fair value, or absolutely overvalued. We come to looking at some of their valuation metrics. Now, this is by far the most subjective rule guideline I do have, because it all comes down to how you think the company will grow in the future. And this is why we can get such a wide range of different valuations from investors, analysis, that sort of thing, because it all depends on how quick or how slow a company will grow. Maybe we think the company won't grow at all, it'll actually go backwards. So that's why we can get such a wide range of different opinions about the valuations of a company. Anyway, for DGL Group, the current markup of this company at $3.08 is $860 million. Now, in isolation, that number means nothing. We need to know revenue, profit after tax, operating cash flow, all those really important financial metrics. Now, I am using pro forma revenue, profit, and operating cash flow. And remember, pro forma means the company is assuming if they made those acquisitions exactly 1 year ago at the start of financial year, these are what the numbers would have been. So these are not the statutory numbers. These are not the real numbers. These are just how numbers would have looked if those acquisitions were made exactly 1 year from the start or the end of the financial year. And the reason I use these numbers at this point in time is when the company does release their financial year 22 numbers, I can compare apples to apples. So if you're comparing the statutory numbers to the financial year 22 numbers, you're not taking into account the acquisitions they have made, and you might be overestimating their growth, if that makes sense. Anyway, revenue, pro forma revenue, 196.5 million, and that is quite significant or significantly different than their statutory revenue, which was, if I remember, something like 140, 150 million. So you can just see the benefits of those acquisitions in terms of revenue. Pro forma profit, 11.3 million, and pro forma operating cash flow, 28 million. Now we come to the valuation metrics. Price of sales, P ratio, EV to operating cash flow. Now, price of sales ratio, 4.4. I'm not sure how relevant that is for DGL Group. But P ratio, 76.1, does seem fairly high, but we already know that there is a chance that profit after tax will almost get to almost double from financial year 21. So there is a possibility we'll see profit after tax in the $20 million range, which would make the PE ratio significantly lower from 76.1. So these valuation metrics are backward looking. They're trailing, they're not forward looking. And if you do look at the potential or the expected profit and operating cash flow, those valuation metrics will be significantly lower than what I have here. And that's also true for EV to operating cash flow. 30.7 is a little bit higher than what I would like, but that's based off their pro forma financial year 21 numbers, 28 million. And I do expect that number to be significantly higher for financial year 22, and that EV to operating cash flow metric to be significantly lower as well. So at this point in time, if you do look at these valuation metrics in isolation, you might think this company is overvalued, but DGL Group is growing at a really good rate. And then it comes down to how you expect that growth to continue into financial year 23, financial year 24. Do you expect that growth to continue? And if you do expect, those valuation metrics don't look that bad right now. That's all I have on this video, why I bought into DGL Group. If you do have any opinions, any thoughts, any questions about this company, about the process I do go through when trying to figure out whether I buy a company or not, I'd love to hear your opinion. This was not a clear-cut buy for me. I did have to be a little bit more flexible when it came to whether share price is in an uptrend. I know it is in an uptrend, but it's just below a fairly significant resistance level. And I would have preferred the share price to be a little bit higher above that resistance level. That would have meant I think the share price definitely would be going higher. But I think the probability of DGL's share price going forward from here or moving up from here is high, but it's also dependent on the overall sentiment in the market. In saying that, share price did rise 3% when the overall market was down 1% on the 11th of February. Last thing I should mention in this video is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.